Hey traders and investors, it's Serge Berger here. Today, what I would like to take a look at is the 10-year bond yields and through the lens of an equity trader, explain to you what to really look for when we look at a 10-year bond yield. I think a lot of people know they should be looking at other asset classes, particularly bonds, uh, but I think very few people know what to actually look for. So let me try to break this down for you very quickly and really to the point. So obviously we've had a big rally in stocks over the past few years as we came out of the 2009 abyss. If you look at the 10-year bond yield, okay, this is yield, not price in bonds. Over the same period, we've basically had a very sharp return spike in yields, and then a gradual move lower, which is part because the economy then really grinded to started to slow, and of course we had an artificial low interest rate environment, i.e. the Fed was buying bonds and keeping interest rates very low, so there was really no reason for bond yields to go higher. In 2013, however, bond yields started to climb until they topped out right in December, and have ever since have started to trickle down. Right now, 10-year bond yields are at about 2.37% or below 2.4%. They were actually above 3% at some point late last year. If we now look at this chart, where I have drawn both the S&P 500 and the 10-year bond yield together, looking back many years, you can see we've had, depending on how you zoom in, we've had a very big divergence ever since we've hit the bottom in a bit in 2009. Stocks continued to climb, whereas bond yields went lower, and that of course is again because the central banks essentially force people into bonds um, by keeping interest rates very low, and of course at some point also then when the stock market started to when the economy started to turn back up, the bond yields started to go higher. So in 2013 we actually had a pretty good positive rate of change in U.S. growth. However, that started to sort of taper off in the back end of 2013, and we've now seen a very big divergence again between stocks and bonds. So bond yields are this red line, and equities, the S&P 500, this blue line. Basically, bonds being a leading indicator made a lower high late last year, but stocks continued to go. So at some point, I suspect that the bond market will have proven right, that the economy is slowing again, and stocks will have to come down. So to sum this up really quickly, what I just said, basically, instead of trying to necessarily look for sort of on a day-to-day basis what bonds are doing relative to stocks, I think it's important to look at it sort of on a week-to-week or month-to-month basis, and it's all about looking for divergences. A lot of things in equity markets or in markets in general are all about looking for divergences where something is trying to tell us something about something else. In this case, I think bond yields are giving us a clue that stocks at some point here are probably going to be running out of steam and going lower along with bond yields. Hope this makes sense, guys. As always, if you got any questions, you can hit me up on Twitter. My Twitter handle is SteadyTrader, and I'll see you in the next video.